This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets.
Indian refiners are avoiding Russian oil purchases for delivery in April and are expected to stay away from such trades for longer, refining and trade sources said. A move that could help New Delhi seal a trade pact with Washington. The US and India moved closer to a trade pact on Friday, announcing a framework for a deal they hope to conclude by March that would lower tariffs and deepen economic cooperation. Indian Oil, Bharat Petroleum and Reliance Industries are not accepting offers from traders for Russian oil loading in March and April, said a trader who approached the refiners.
Oil prices fell 1% on Monday as immediate fears of a conflict in the Middle East eased after the US and Iran pledged to continue talks about Tehran's nuclear program over the weekend, calming investors anxious about supply disruptions. Brent crude futures fell 67 cents, or 1%, to $67.38 a barrel on Monday by 0444 GMT, while U.S. West Texas Intermediate crude was at $62.94 a barrel, down 61 cents, or 1%. With more talks on the horizon, the immediate fear of supply disruptions in the Middle East has eased quite a bit, IG market analyst Tony Sycamore said.
Moving on to the top news in the energy sector.
The U.S. United Steelworkers Union adopted on Friday a national agreement on pay and benefits, averting a nationwide strike that could have affected 30,000 workers at 26 companies operating crude oil refineries and petrochemical plants. The agreement was negotiated between the union and leading U.S. refiner Marathon Petroleum on behalf of the refiners and chemical producers. We are pleased that Marathon and the USW have successfully negotiated a pattern agreement for new collective bargaining contracts in the U.S. refining industry, said Marathon spokesperson Jamal Carey. We look forward to our local sites moving forward with the ratification process.
U.S. energy firms this week added oil and natural gas rigs for a third week in a row for the first time since November, energy services firm Baker Hughes said in its closely followed report on Friday. The oil and gas rig count, an early indicator of future output, rose by 5 to 551 in the week to February 6, its highest since November. Despite this week's rig increase, Baker Hughes said the total count was still down 35 rigs, or 6% below this time last year. Next, we have the top news in metal markets. The U.S. is using offtake deals and state-backed funding to compete in the short term with China in securing supplies of African copper, cobalt and other critical minerals, diplomats, executives and analysts said ahead of this week's Indaba. Washington's focus is on Zambia, Guinea and Democratic Republic of Congo. The latter accounts for more than 70% of global cobalt supplies and produced some 3.3 million metric tons of copper in 2024. Instead of placing U.S. operators in high-risk countries, however, the U.S. is leaning towards offtake and other trading structures such as one it has with Mercuria and arrangements it has with Congolese state miner Gécamines, to edge output into U.S.-aligned value chains dominated by Chinese refiners.
Dalian iron ore futures edged lower for the sixth session on Monday, as China's inventory rose amid a low-demand environment, and Australia's major iron ore hub resumed port operations after a cyclone warning. The most traded May iron ore contract on China's Dalian Commodity Exchange traded 0.46% lower at 761 yuan and 50 fen, $109.89, a metric ton. The benchmark March iron ore on the Singapore Exchange was 0.57% higher at $99.60 a ton as of 0705 GMT. The Singapore benchmark fell below $100 a ton as demand in China slowed ahead of the Lunar New Year holiday.
We will now look at the top news in the agricultural sector.
Chicago soybean futures retreated on Monday, pressured by rising competition from South America, after 4 straight sessions of gains driven by U.S. President Donald Trump's comments last week that China might increase purchases of U.S. beans. The most active soybean contract on the Chicago Board of Trade fell 0.38% to $11.11 a bushel by 0254 GMT. Soybeans had surged to a 2-month high last week after Trump's remark that China was considering lifting U.S. soybean purchases to 20 million metric tons for the current season.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.